Hey guys, this is Bob with Trade Genius. Got my good friend Phil here. We're going to show you a chart today that you don't want to trade without having it. Stay tuned.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
Okay, Phil. So this week, the Treasury Department went ahead and fired off their first bond sales they've done in, I think, 4 months. And the big worry was, will the bank's going to completely fund it? And they haven't. And so now we're at this point where we're starting to see a bit of creep up here into the overbought and into the euphoria levels. And I just want to throw it to you, and maybe you can explain this chart to people and tell people, how we use it and why this is important to know, and why if you're going long now, you're probably an idiot.
Yeah. All right. So let's dive into the chart here. So there's 3 components that we have to this thing. One is the blue area is basically the liquidity. Okay. That's what fuels the market right now in our current environment. And that's going to be our current environment for the foreseeable future because of the actions of the Fed. The second thing is you'll get these risk on and risk off signals. Okay. These diamonds. And that is essentially telling you that, hey, the flow in the liquidity is changing, and you should be, they're putting net adding liquidity to the market, meaning that, the market has fuel to go higher. And so that's basically your risk on or a go long signal, or risk off, or, go short or hedge or go to cash signal. Below that, we have the fair value, and the fair value is measuring the S&P 500's level relative to where the liquidity is. So it basically gives you an overbought or oversold condition like an oscillator would give you, right? So if we go back to where quantitative easing ended, right? Beginning of 2022. So you had 2 things going on. You had quantitative easing stopping and going into quantitative tightening. Okay. And we're still in that condition. It's still a quantitative tightening environment. You had that, and you had Yellen just getting into replenishing her checking account, basically. And that's the conditions we're in again today here. So it's the same macro conditions that we were in at the beginning of 2022. We are exactly in that right now, starting this week. So as you can see from that previous condition, we had a large sell-off, right? Now, mind you, the economy wasn't giving us all of the recessionary indicators that we have been showing you guys over the last few weeks, right? Like a lot of things have gotten much more bearish under the hood in the economy than what we had back in 2022. So we've got, like, I would say double the headwinds going into this situation. So with that being said, what you want to do is you want to look. And there's, we'll take risk off, and then we'll also look at our other indicators. And for you, that could be anything that you rely on for giving you an overbought or oversold signal, say on a daily chart. You can combine that. And when they both agree, that's like really a good signal. But for us, we really like it when we get to this upper bound, which is this upper red line. That is your what we consider euphoric level, where you're so far over fair value that there's no more gas to the upside. You're going to have a snap back down, and so that's what this market has been doing over and over and over again. And so you see it here at the beginning of 2022. Again, it comes back up, and what do we see? We see it top out here and it rolls over again. And these aren't like 1 or 2 day rollovers with like 100 points. These are a week or 2 or more, hundreds and hundreds of points, right? So you make big money getting short into these gyrations. Okay, here we come up, we get poke up, hit euphoria. Okay, roll over hard down. Okay, that was your first major big low of the bear market. Okay, then we get to the other extreme where it's oversold, right? And so you get below fair value, you get into these green zones where it's like bounce or, swing long, and it comes right back up again. So quite literally, if you just wanted to swing this market up and down, this thing is just really, really good at that. You can do it in futures, you can do it in shorting, maybe the SPY, or you can do it in options. And there's a couple different ways you can do options. You can just buy puts, buy calls, or you can do credit spreads. Won't get into all that detail, but if you want to learn more about that, you're welcome to come into the room. Bob Bob will teach you all about it. But there's just multiple ways to play this. But again, going back up in to August of 2022, I'm arguing that this is very much like August of 2022. The sentiment is the same. Everyone's max bull. You know, you got a very steep trend line going up, and then in the course of 1 week, you start unwinding the whole thing with a V reversal and then a very steep drop off, basically Eiffel Towering the entire move. Okay. And no one saw it coming, except you knew that fair value was up here in the euphoric levels again, right? You don't want to be long if you're getting euphoric readings. I mean, you can get a sell-off and you might chop around on the lower part of the sell zone there, and you might have a week or two or maybe one last push higher that does give you a euphoric reading. So that could be the case here. But in any case, if you're getting short in this area, the payoff is huge. And so that's why you want to, if you can, layer into these conditions, because the sell can come at any time. Okay, so we come back down, we get into oversold again, get the liquidity oversold reading, bounce, boom, back up. This oscillation is very, very reliable. We come back up into December of last year, end of last year, we get the sell reading there, right? Roll over. In the meantime, you've also got risk on and risk off firing. So if you've got these conditions, right, you get oversold, it's either risk on come on if you want to wait for that. Boom, you go with that. You can wait for confirmation on these if you want. But again, come back up. Here we go into February, right? You can see liquidity dropping way off. We're way over our skis. We're at euphoric levels. I think we were warning you guys about this on the channel then, and we roll over. Then comes back in. I think people miss the fact that, you know, we were risk on 2 times since then, right? We had a risk on here from these levels, come up into that euphoria level again up here, was risk off. Didn't get too much of a drop here. We chopped around, but then it said, hey, liquidity's coming back in. You got to be risk on. Okay, so middle of May, risk back on. And here we are, up a couple hundred more points. But we're now in a situation again where we're up here and going into OPEX Bob and the Treasury. We can show them what's going to happen next week. We got a big drop in liquidity coming. So, and we know that ahead of time, and we know that most likely that's going to probably trigger a risk off signal.
Yeah, and Phil, do me a favor. Can you zoom the chart in where we just see the 4 trend lines, and then also for our viewers, can you then just show the euphoria thing? Maybe make that bigger relative to the chart so people can kind of see that a little bit better. Yeah, perfect. So this is when you want to trade this. Phil's a fat pitch trader. Okay, I like to trade a little bit more aggressively than he does. But if you had this tool, okay, and this tool is $179 a year, okay, and if you every time, if you just simply wait it for where Phil had the red circles and you bought $1,000 worth of call options, okay, every one of those red circles would have been a double or a triple for you, okay? The same goes on the euphoria side too. And what Phil recommends in this model for people that already have it and people that want to buy this is that Phil always recommends you go out 4 weeks on your trade, okay? So you give yourself some room for it to breathe. And then how you manage to trade is as the price goes in your direction, you just roll your contract up to the next strikes higher. If you don't trade options, you could simply buy, SSO or SDS and trade it that way. And I think you'll be well pleased with what this does. And like I said, this is not a day trading tool. It's a swing trading tool, and you can use it very effectively. The way I like to use it, in addition to taking these big fat swings, is that if you're in a risk-on situation and it gets euphoric on you, then that's where you could sell calls. If you're in a risk-off situation and it gets oversold, you could sell put spreads. So there's many different ways in which you can play and trade that. What's been giving us caution is that this risk on signal came on right ahead of a change in the basically the political and financial environment, and the price of the shares were already at a short hedge area, and that's why we've been very nervous on this last risk on to do anything. And if you look at where risk on came on, is that the price really hasn't moved much, and so that's why we're nervous, and that's why we're bearish this time. Is that look, at any time Yellen can, and Phil's going to show you a chart here in a second. At any time Yellen's going to push in, and what we've seen here with the Fed liquidity report is that the banks only took up half of what she did, and she has to do hundreds of billions of dollars of this stuff, and it's just going to be a cumulative effect on the markets. And you're going to get a tell from us on risk off. You're going to hit euphoria, and also watch TBT. If TBT gets another bid, the market doesn't like that. It's saying risk off with the bonds. and basically risk off with the market. So with that, like I said, you can just contact us, tradinglikeagenius.com. I encourage you to get this. This is dirt cheap. We should probably charge a lot more for it, but we don't. But you can just check in with Matt. Just hit us up. 1-800-949-1408. Just ping us, and if you remember, just ask Matt for the promo code. You can even get a better price. So with that, Phil, I'm going to throw it back to you. We can show them the what's coming up on the next bond auctions and how much they've already thrown out here already. I mean, a lot of money has been put out on the bonds in their first week.
Sure. And right before we do that, this is a weekly look on the chart, and you'll notice too the risk. So you get more signals on a daily, but if you're just going to go weekly, you can see if and some people like to just look at a weekly chart because they're managing a big portfolio or whatever, but this does a really good job of letting you know on a weekly basis of the liquidity flows. You had risk off basically at the top of the market and didn't really get risk on until here. So if we get a weekly risk off, that's kind of the next thing we're looking for. That's going to be our confirmation essentially that we're going into that bearish scenario we think we're going to get in the second half of the year. So this is really good for bigger positioning on your portfolio. If you get this risk on, then the hedging or the selling you did up here, you can put it back to work, and then you can ride that until you get another risk off. But it's a really good way to protect yourself, right? Especially after a big run up like we had. So also works with less signals on the weekly chart as well. But to Bob's point, here's what's going on. We got weekly auctions coming up. We got a lot of debt issuance. And right now we've got this offering amount here. She's going to do 65 billion, 58 billion, and 38 billion all within next week. Okay. That's all money pulling away that would normally go into stocks and risk on assets, all coming out of the market. So what that does, it's going to make what we're going to see next week is a drop most likely in this blue line. Okay. And let me go to a daily chart here, but this is a situation where when we get these large divergences from the blue line on the price action here, that's when we get nervous about what's going on. And again, like last August, it was pretty stark. February, this is February here. Last August, we had another situation where liquidity wasn't confirming the move up, it was going sideways and rolling over. Meanwhile, the market's just jetting higher. Okay. And that's, you get those euphoric readings. And so those are the last two times we've seen that. And we're doing that here again. Okay. We're getting away from liquidity that's essentially starting to go sideways here in the market's acting like there's more liquidity coming into the system. So when we get that risk off, which we think is very possible next week, you'll need this template to confirm that. We should see this to roll over, but that's a lot of auctions to be having in one. That's over 100 billion coming out of the market next week. And on top of that, the Federal Reserve, their schedule is anywhere from 20 to 50 billion dollars away from the market in terms of their balance sheet roll off every week. They take a week off on the fourth week. So it's like 3 weeks on. In the fourth week, they don't roll off really. Sometimes they add back a little bit. And that was the case this week. So we didn't really see huge draws on liquidity this week. We're going to see huge draws on liquidity next week. And that's why we think this is a real pivotal spot here. We also have OPEX next week, which means that a lot of what's happening here is just pinning effects from the hedging that goes on around OPEX. And once OPEX is done next week, and usually you go up into about Tuesday or Wednesday of next week, and then lately you've been rolling off beyond that. So once OPEX expires on Friday, okay, there's not much holding this up at that point. In fact, we got quite a bit of a liquidity void under us. So you got to be really careful here, more so than we were since the middle of May. There haven't been too many situations that were too precarious because risk on and liquidity was coming in. But this spot is much more dangerous now because of the setup going into that, Bob. So you just got to be on your toes here. Yeah, absolutely. And guys, we think this is a very, very important chart. And really nobody shows it the way we do. And it's really, very helpful. And we use it. Phil pulls multiples of tens of contract points out every time he takes these hits. And pretty funny because, people kind of make fun of Phil a little bit because Phil just sits there and says, nope, I'm short. Nope, I'm short. Nope, I'm long. Nope, I'm long. And everybody's saying, but. And then 3 weeks later, he goes, yep, I just extracted 140 points. I just extracted 40 points, and because we just know how this tool works. And I think you guys would love it. If you trade futures, you should definitely look at this because, if you trade with the trend and with the flow of the Fed, then, you're in good shape. And a lot of people don't know how this stuff works. And this Fed liquidity thing, just in general,
general is that they're going to become more and more important to the market because they just have all the money. And so as the banks breathe and the Treasury breathes and as the Fed breathes, that's our market anymore. You can forget fundamentals. They don't make any sense. I mean, you just have to look at NVIDIA and supermicrocomputer and Tesla to know Fidelity, basically fundamental analysis is worthless. And you have to look at liquidity from now on. And it's just an amazing thing to watch. But this is the world we live in. So let's trade the tools. Let's trade with the Fed. And with that, Phil, I'm done. And with you guys, check it out. Hit like or subscribe. Tell your friends about us. We're going to be talking more and more about this. And whenever we get a big turn, this will be the subject of our podcast because we want you guys to all to make money. And like I said, hit like and subscribe and tell your friends and help us grow the channel. Thanks, Phil.
All right. Thanks, guys. Talk to you later.
Trade Genius.